Welcome, everyone. We're going to give it a few minutes here for others to join. Thank you for being here. Hope everyone's having a great day so far, but we'll probably give it a minute or two for other people to join the meeting, and then we'll get started with Bryce shortly. A few others hopping on now. Hello to those who just joined the call. We're going to give it another minute here to see who else joins today, and we'll get started soon. Okay, Bryce, I will be watching to let anyone else in as we start the chat today, but I will tee it up a bit. So I think I know pretty much everyone on the call, so I won't give too much of a combine overview, but thanks so much for joining us today. Um, I guess something new from the Combine standpoint is we're starting this new webinar series. So we will be offering 3 different webinars per month. Some of them will be directed towards startup companies, some are more geared towards farmers, and some will just be more general info, but you're always welcome to join these. So just stay tuned for that info. But just happy to be here today and excited to have Bryce share his info with us. And for everyone on the call, I think this will be a great topic for everyone here. So I'm excited to hear from Bryce just a little bit of his take on the investment landscape and his perspective on just the pathway to investment, especially in ag technology. Just some info for today. Save your questions till the end, and we will do a Q&A later on. And with that, Bryce, I will have you kick it off.
Jesse, great to see everyone. My name is Bryce Wilberding. I'm a vice president at Lewis and Clark Partners. Lewis and Clark Partners is a food and agriculture technology investor based out of St. Louis, Missouri. Uh, I'll break down what we mean by food and agriculture technology and then where we play in the space. So, within food and agriculture technology, the space we invest, we really invest across the food and ag value chain. So AgTech is a portion of what we do, but we cover everything in the supply chain from upstream R&D, going into inputs and food products to on-farm technologies through the supply chain and processing all the way to B2B food technology. So in short, we cover the food and ag landscape, but don't invest in farmland and we don't invest in uh, branded CPG products. So avoiding the two ends in what we call the messy middle of food and agriculture. Stage wise, we consider ourselves later stage venture and growth equity investors. On the venture side, we think our sweet spot's right around the Series B, but have flexibility up to Series A and through Series C. Uh, we'll spend more time here talking about what late stage investors look for in a company and what defines a successful late stage investment in food and ag or in ag tech specifically. So I won't get too far into that now. And then on the growth equity side, a sliver of our fund is allocated to what we consider growth equity in food and agriculture. That's EBITDA positive businesses, that may be family owned businesses for a number of years looking for a legacy transition or some growth capital to pursue a specific initiative. Um, so I know we're going to spend a bunch of time talking about what I'm seeing in the market, what later stage investors look for. Uh, so I won't get too deep into that now, but I will comment now on the food and ag investment landscape at a high level. So if anyone has followed the venture capital landscape since, I don't know, 2016 through and beyond, food and ag venture capital as an asset class really started to kick off in the late teens, when you started to see large exits from companies like Climate Corporation to Bayer. And so you had a number of funds enter the space around 2019. There are earlier funds, of course, but you really saw the influx in 2019. You also saw an influx of climate investors enter the space. Uh, Through 2020, 2021, you did see what I'll call a peak in the market, and that was venture wide. Uh, and what we've seen since 2021 was 2021 being that peak of the market where significant money was flowing into all of venture to include AgTech and all of food and ag venture capital. Uh, Post 2021, you saw a drawdown across the entire venture landscape, and food and ag tech was no exception. What we're starting to see now, so we've seen that decline. What we're starting to see now in the last year or two is what we call a bifurcation of the market, where one, there's the bifurcation between AI and non-AI across the venture landscape, where AI is seeing massive funding rounds at incredible valuations. The rest of the market is not seeing that same recovery, uh, but is still seeing a further bifurcation in the companies with the right attributes are certainly being funded. There is just less funding in the space. Investors have become more conservative in what they look for, and we'll talk more about what we look for, to the point where if you meet those attributes, companies typically don't have a challenge fundraising, but the ones who don't are having a much harder time. And so everyone's gotten a lot more disciplined in how they allocate their capital, starting with the companies we're seeing prioritizing profitability, low capex businesses, to raise fewer dollars, to a successful exit. And we're seeing that across the market. The other big trend we're starting to see uh, is a result of AI. So within the venture landscape, you are seeing a number of dollars flow into AI, a majority of dollars flow into AI. But you're seeing the market respond in prioritizing uh, defensive industries. And so in the past few years, I'll call out that hardware as a venture capital sector has seen as low as 4% of funding. In Q1 of this year, I think PitchBook cited up to a quarter of of venture dollars went to uh, more capital intensive industries in hardware, industries where you have a moat that AI cannot replace. And so, like many others, we do see opportunity in AI, but we also see opportunities in the industries that are hard to replace. And that's one thing we love about food and agriculture, is that it's not going anywhere. Whatever cycles exist in other markets, food and agriculture has their own cycles, uh, but they tend to be uncorrelated. So I could talk about all the reasons we're bullish on the industry. I could talk about all the fundamental shifts we see. Uh, but I'll pause there. I'll pass it over to Jesse, and then I'm happy to answer a bunch of questions.
That is a great segue. Almost didn't come off mute there. Um, I think that's a great start. And my first kind of question to keep this conversation going. So, as I'm looking at who we have on the call today, for our startup founders, all of our founders today have gotten some funding, and they're either at the point of thinking what they'll need for late stage funding, or it's just good to know once they get to that point later on. So, as a late stage investor, what are you looking for with founders? And for our early stage ones, how can they like be thinking of that now?
Yeah, so I'm going to be specific to Lewis and Clark. I will call out that I do not speak for every later stage investor. Um, I do talk to most of the other mid to late stage food and ag investors, and I think we're aligned on a lot of this. But Lewis and Clark specifically has a defined list of criteria we judge every investment on, just as a starting point. And there are uh, I think if you meet all these criteria, you're a perfect investment. That's never the case though, right? You're always going to give on something. But of these characteristics, and I'll go through them all, there are three that are the most important to us. The first is what we categorize as a top tier team. So this is a C-suite with a high level of execution and vision, demonstrated success doing hard things, and expertise in the industry or the problem they're working to solve. Uh, so if I were to summarize that into advice for someone at the earlier stages, it's your first 1 to 2 to 3 hires are the most important hires you'll make. Uh, Next would be product market fit. And this is a notoriously challenging benchmark to measure because everyone has a different definition of product market fit. But to us, it means that your product or service or whatever you're selling has found the forcing functions of change and deliver something unique and enduring to address demand. Said differently, you know what your customers need. You've done countless customer interviews. You're not fitting a square peg in a round hole. And we solve this a lot of times through customer calls. What we need to hear is from both customers who are using your product or service, they cannot live without it. And then for the customers we talk to, or the dissidents, we would call them, those who aren't customers or maybe don't agree, we can get over their rationale for not being customers. But we really want to see that there's a strong pull from the market for what you're selling. The third most important is going to be a path to outsized return. We are financial investors. Anyone in venture is going to be a financial investor and is beholden to our limited partners and our investors to deliver returns. This is something I expect we'll talk more about based on some of the questions Jesse sent over, but this is probably the biggest hurdle in food and ag tech venture is that you have an exit market that's dominated by 1 to 300 million dollar M&A transactions to your OEMs, your agrochems, your animal health companies, etc. And so the way we solve for a path to outsized return is through disciplined valuation, which can be a difficult conversation with a founder and setting realistic expectations for the right valuation, and or it's a path to adjacent markets. So it's finding a technology that has a core use case in food and agriculture or in ag tech in the specific case, but has applications in adjacent markets where you broaden that M&A aperture. And that is both through growth. There are, no matter what your business is, with the right growth characteristics and financial characteristics, there's a financial buyer. But if the exit is through M&A, which a majority of ag tech exits are, finding applications where maybe today you're the perfect fit for a Cargill or a Deere, but you've demonstrated that technology today, but on your roadmap you have applications in I'll use Deere as an example. Maybe today you're a perfect fit for Deere, but you have applications on your roadmap where you may be also a great fit for a broader logistics trucking company or in IoT devices, a Samsara. But that path to outsized return is crucial to investors. Some other characteristics we look for, and I'll just kind of run through these, but they're all important. I named the top three, but looking for demand pull, looking for enduring differentiation, both through IP and proprietary processes. It's kind of a lazy question these days, but having a good answer to how somebody can't recreate what you're doing with AI in a garage. Strong pricing power, growth momentum. I'll stop there and say that growth solves a lot of things. Uh, you're in a growing market. You have quality revenue, so diversified customer mix, uh, high gross margin, and then asymmetrically low risk. So we want to see companies that have demonstrated that they are, if there are regulatory hurdles, they've surpassed those regulatory hurdles. If there are, uh, if there's a deep technical expertise to your product, you have, at least for your core product or service that you're selling today, you have those technical bugs figured out, and any technical challenges you meet will be on future products. Uh, and and I think capital efficiency ties into asymmetrically low risk as well. Uh, I mentioned that raising capital in today's market is challenging. So we do like to see companies where maybe you're raising capital for a growth story, but you have a disciplined understanding of your CapEx and operating expenses to the point where if you needed to pivot towards profitability, that's something you could do. So that's high level. That's kind of the lens we apply to all investments, no matter the sector. Uh, but I'll pause there, Jesse. How's that?
I think that was an excellent answer. And again, if anyone has questions, we will get into the Q&A a bit later. So just put a pin on your question for now. Let's go to a little bit of a different topic. We talk about this in the Combine quite a bit. Um, how would a founder know if going down the venture capital pathway is right for them or not?
Yeah, that's a great question because I think the second you take venture capital, you're committing to you're committing to a specific business model. You're committing to tripling or doubling top line every year. You are committed to first and foremost, you're taking on a board of directors, and you, as a CEO, do report to that board. Um, but you are committing to certain expectations, and part of that comes down to how venture versus non-venture businesses are valued. Because venture businesses are valued on a growth story or sometimes even a revenue multiple because they're typically unprofitable today. Uh, you are committing yourself to a path of growth where you will grow into that revenue or you will grow into that story versus a company that doesn't take on venture capital and bootstraps. You're going to be slower growth, but you're going to own 100% of the business. You can sell for I'm gonna air quote smaller exit. Uh, but to you as a CEO or the founding team, that exit may be more material than the dilution you take from venture. And so it really comes down to the growth and the exit you are seeking. There's something we talk a lot about, like, uh, do you as a CEO want to be rich or a king? And we like to see CEOs that want to be rich, not kings. And unfortunately, a lot of the rationale for raising venture capital is has to do with that king mindset, where uh, there's a status symbol around raising outside capital that you've convinced investors that you have a good idea, a good product, a good business, Uh, but I think you need to think really critically about what's the path that's going to make you rich. And if you're a business that's going to need to raise a lot of capital and exit for hundreds of millions to billions of dollars, uh, your odds of being rich are realistically probably lower. Um, what we take and what every venture investor takes is a portfolio approach to how we invest. Like we invest for the big outcomes. That's in our best interest. But as a CEO, and that's gonna have companies that do really well, and it's gonna have companies that don't do very well. And we're willing to accept that risk on across a portfolio. Um, but what's your risk appetite as a founder? Are you willing to accept a company that uh, a company that goes to zero? I think your risk appetite could potentially be lower than ours, or any not ours, any venture capital investor. Uh, I and I'm going to take a step back because I've been kind of pessimistic about venture capital in the last 2 minutes or so. Uh, but then the rationale for taking venture dollars is finding investors who can help you scale. Capital is one thing, whether it's to develop a product, to build inventory, to grow your sales force so that you can grow the business 300, 200, 100% year over year. Uh, but the best venture dollars are the ones that add more than capital and can connect you to um, the right strategic discussions, that can connect you to the right customers that have been through this countless times. And as a board can tell you, here are the lessons we've learned having done this with so many other companies. Here are the frameworks we would use to build this company. Here are the playbooks we'd use. And so when you do take venture dollars, you really do want it to be fuel to a fire that already exists. It's not a solution if there isn't already a fire, if there isn't already product market fit, if you're not building a business that the market needs. But if you are, it is an accelerant. And so that's what we look for is, I think I outlined it with like all the criteria we look for in a business. That's kind of I think of that as your fire. And then if you find the right investors, it's capital, but it's more than capital. It is that fuel via relationships, customer introductions, expertise, um, and access to broader markets so that you can grow that business. Because the beauty, I think also the beauty of venture is that your incentives align immediately. Um, we like when I think about being rich or a king, as long as your goal is, I'm I'm speaking as a capitalist here, right? But as long as your goal is to be rich, that is also in your venture investor's best interest, and you work together to make that happen. So I maybe a bunch of questions there, because I do think that's the most important decision you can start to make early in your company's life is to understand your risk tolerance and what type of company you want to build, because it's very hard once you're on a venture track to get off the venture track. But once you're on it, there are a ton of benefits to being on it, as long as you understand the risks as well.
Very good. Next question. In your opinion, what do founders commonly get wrong about raising and scaling?
Hmm. Uh, first and foremost, and this is at any stage, it's not understanding your customer. Um, a challenge I see a lot is really smart people who have specialized in one specific thing, and it's what they know. Uh, and I don't know, let's say you've spent your career working on one specific problem or one specific research area, and you can build a really incredible product around that. But if you haven't interviewed 100 potential customers to understand their key pain points, uh, you risk building the wrong product or service or whatever it is. And so that's number one. Uh, some of the way that that materializes is as an as an early, mid, or late stage founder, uh, it can be it can be enticing to have a lot of investor conversations. And you'll want to build investor relationships before you raise. But that should not be your key focus. If your key focus, number one, is the customer, whether it is the farmer, the retailer, a strategic in an enterprise contract, if you understand what they want, or if you understand what they need and you can solve their pain point, uh, you probably checked most of the blocks on that criteria list I started with. And if you have that, the investor conversations become a lot easier. Uh, so I'm probably not saying anything revolutionary. It's customer first. If you're familiar with the lean startup method, I think that's an incredible framework for building a business. Um, so that's number one, is not spending enough time with your customer. And then the sub point of that is focusing too much on how to raise capital and not enough on building the business that will raise you capital. Um, some other some other minor mistakes I can see are fundraising at the wrong times. This is something I run into quite a bit in that uh, when you go out to raise venture dollars, you want before you do that, you want to establish internally what are the key milestones that, if it's a Series A, what are the key milestones that Series A investors will need to see? And you'll understand this by having those conversations earlier, um, but getting aligned on the stage your business is at and the capital you're raising. So really meshing the two, because some of the hardest conversations I have are hearing really great businesses that just don't meet our stage criteria, um, or who have maybe surpassed our straight stage criteria. Uh, and so getting a good sense of what investors need to see for a $10 million Series A, for a $15 million Series A, for a $20 million Series A, first, and then having a clear view on what that capital is used for. The worst answer you can give is runway for the next 18 to 24 months. What we'll need to see, what I think every investor will need to see, is this capital does X, Y, Z for me, whether it's to help me expand my sales force so that I can sell into X, Y, Z, so that I can uh, build out product A to tackle new markets, um, you name it. And those milestones that you are raising towards should also be the answer to what the next stage of investor needs to see, or what the acquirer needs to see, or what takes you to profitability. Um, so I think those are maybe the two key mistakes I see. The first is fundamental. The second is more of a nuance of the fundraising ecosystem and how investors operate.
Excellent. I think that leads right into the next question. I feel like this is kind of a tough one, Bryce. Um, how, okay, so how does the ag tech capital environment shape what a founder should expect as the capital environment changes and evolves?
Yes. The advice I would give anyone starting any business anywhere is start with the question, what is my end goal? Uh, or what is my end state? If if your goal is to build a lifestyle business that cash flows and that you can live off of, that's great. And you probably don't ever need to raise venture dollars. And you probably shouldn't raise venture dollars. But if you do raise venture dollars, you need to ask yourself, how do I exit this business? That's what your investors will need to see. Most funds have a 10-year lifespan where they make initial investments in the first 5 years, and they aim to exit investments in the back 5 years. And so it's one of the first questions we ask when we're evaluating a company is how does this company exit? Because we owe it to our investors to return their capital. So you need to ask that same thing of yourself. And then in understanding how you exit, you shouldn't have, yeah, no one's expected to have a perfect view, right? Like it shouldn't be tomorrow. You have time to grow into a business that scales, but you should have an idea of, does this company exit to Cargill or Deere or Elanco? And if so, what do those companies pay for companies like mine? Um, and so this kind of brings me back to the one of our criteria um, in exit opportunity and path to returns is if you think your logical acquirer is Cargill or Bayer, but they don't spend more than, or they haven't historically spent more than $300 million dollars on an acquisition, uh, what's the most capital I can raise to still myself as a founder see a meaningful return? How much will I be diluted along the way? Um, do my investors have a path to outsized returns as well? Um, but that's probably the most important question. And then if you can, the next step is, okay, if an exit to Cargill or Bayer doesn't doesn't give me the return profile that I as a CEO would need to see to start this business, are there adjacent industries that overlap? Um, I'm gonna call out. Maybe I shouldn't. But there's a company on this call that I think does a really good job of that. Uh, that has that has pure applications in food and agriculture, but there's a broader landscape that opens up what the exit could look like. Um, and so in answering that question, you really got to think about how much capital I need. Uh, it's why we prioritize capital light businesses. Uh, it's why we prioritize low burn businesses. Um, but that is okay. That's number one. Remind me the question again.
So, as the ag tech capital environment changes, evolves, how should founders adjust their expectations?
Yes. Okay. So number one, um, associated with that exit landscape, if the answer to how this company exits is a $1 to $300 million acquisition to one of the majors, I need to be prepared for pre-seed, seed, Series A valuations that support returns at an exit to 100 to $300 million. It's incredibly hard as an investor to look at a company that we think will exit to Bayer for 1 to 300 million, but they're pricing their Series A at 50 to 100 million pre-money. There's just very little room for returns at the risk we're taking. And then second, I mean, capital is very hard to come by. Uh, and like I said, it's not just in ag tech, it's across the venture landscape. If you're not building, at least for now, if you're not building the next SpaceX or Anthropic, their capital is concentrating in those sectors. And so you need to be prepared that fundraises will take longer. If the typical fundraising timeline was 3 to 6 months, you probably need to plan for 6 to 9 months. And you need to expect that that timeline is going to get longer at each stage. Um, if you've raised capital at the pre-seed or seed, I know plenty of people who've done that in weeks, and it's incredible. But you need to expect that the diligence at each follow-on stage of investment will get deeper. Your data room should be more robust. You're going to answer questions you haven't expected to answer before, and that's going to take a lot of time. And everyone wants it to go faster, believe me. Even the investors wish it could go faster. But at each stage, investors are each stage of investor has a different risk to reward profile. And the later you get, because valuations are higher, your reward is typically a little lower, which means you can accept less risk, which means diligence gets a lot deeper, and can take a lot longer. And then finally, because capital is so difficult to come by right now, and there are a million reasons. Liquidity is the number one. Liquidity from the limited partners who invest in venture funds, to the number of venture funds, to the size of venture funds, to who's investing in AgTech. Capital is difficult to come by. And so I think it's always prudent to have a plan for how you get to profitability. If the only way you survive is to raise the next round of funding, not only is that a less attractive business, but you've now increased your risks significantly. You're relying on others for your success, versus scaling the business organically in any way you can through customer relationships, effectively top line growth, and then disciplined OpEx spend. The the best position a founder can be in is to raise capital to pursue growth, but you don't need it. Um, to the point where you can negotiate from a position of your capital, you venture investor, your capital helps me meet these milestones to scale the business faster, to pursue this growth area, to pursue this adjacent market, etc. But I have cash on my balance sheet and I know how to manage my burn to the point where I'll be okay without you. Um, and and it used to be something I'd preach as like get to a position of negotiating strength. Now I think it's almost an imperative given how difficult it is to fundraise.
I think that was an excellent answer there. Okay, now let's pivot a bit and we'll open it up for audience questions. I see that Eric Dinger already put a question in the chat, so I will read this off. Okay, the profitability comment could lead a founder to distract their team from their core mission in pursuit of broadening their product or service with customers who trust them. Can you speak more to that?
Yes. I'm not telling I'm not telling you anything. But I'm not advising that you cut all burn to be profitable. What I'm advising is that you you build the business in a way that you aren't reliant on raising a Series A to raising a Series B to raising a C to an D to an E and so on, uh, to the point where you don't have control of your spend, uh, and can't take the company to profitability if you needed to. Uh, it is this is a friction point, absolutely. Like this is why venture capital exists. If everyone was profitable, they wouldn't need venture dollars, right? Uh, and I and and I would happily invest in a company that's unprofitable as long as they're focused on the right growth. Uh, what I'm trying to be is really transparent about the fact that if I were in a CEO seat, I would keep that focus on growth first, and maybe you need venture dollars to do that, but have a fallback just given the current market that you can still feed the mouths on your team, that you still have feasible exit paths, that you're still building an enduring business if you switch focus to profitability. I hope that answers your question. If it doesn't, hit me with another one. Feel free to challenge me, please.
And I would say for anyone with questions, either just put them in the chat or come off mute and I'll call on you. Okay, Eric Dinger says in the chat, can you share an anecdote of someone who rode that line well? Like make it a bit more of a tangible example.
Yeah, I want to be careful about I don't want to get into our portfolio in depth, but we've seen this a number of times. So uh, companies who have raised significant venture funding and have been met with a challenging fundraising environment, uh, who have not necessarily pivoted, but had in their back pocket a story and an understanding of their spend, um, to the point where they were prepared to move to profitability if they had to, such that if you can't raise the next round, like you survive. Uh, Other companies who, another company we're confident could pivot to profitability today, and that would be a good outcome. But what venture investors and what this specific CEO wants is not just a good outcome, they want a great outcome. And so they have this story to tell that we'll we'll raise and we'll seek an attractive valuation so that we aren't diluted meaningfully, so that we can increase the opportunity for our investors. Uh, but if that doesn't pan out, we've got a plan B. And it is like I understand your pushback. It does feel theoretical, and I think the reason it does is because every business is so different. Uh, and I don't want to get into too many specifics. It's also really challenging to do this in practice, but to have at least thought through this, I think sets you up for success, such that if you meet speed bumps, and every founder inevitably meets speed bumps, uh, it's exactly why I am not a founder. I don't have the risk tolerance, and I have the utmost empathy for CEOs and founders because they're willing to take on this risk. Uh, and why I think it's prudent to think through these alternatives and be prepared for when there are speed bumps. Is that fair?
Excellent. Yep. Eric says yes in the chat as well. Let's go to the next question. You mentioned fundraising was easier in 2021, and then we know it's gone down since then. Any indication of when it may get better? How long do these cycles generally last? This is a fun one.
Yeah. So we'll talk about why venture funding slowed down generally in 2021. So it was driven by um, so first you have to understand that venture capital is a private investment asset class that is just one of many asset classes across all investing sectors. And so while venture companies typically don't take on significant debt, uh, interest rates rising in 2021 had a material impact on the private markets, uh, mostly in the buyout side of the world, but it also directed a lot of where capital flowed. Um, and so post 2021, you saw fewer acquisitions because interest rates had risen. So fewer public companies and larger privates buying startups. When you see fewer acquisitions, you see less liquidity for the investors. So venture investors through the past 5 years have typically seen lower liquidity. So one of the metrics we're measured on, or all venture funds are measured on, is something called DPI, or distributions paid in. It's when we return capital to our investors. And when you saw a lack of exits through the last 5, 6 years, uh, that capital hasn't flowed back to the limited partners who invest in the private markets. Um, and so you've had this cycle of limited liquidity. I think that starts to open up with the exit market opening up. A lot of the same private asset allocators uh, who are invested in SpaceX, Anthropic, OpenAI will see significant liquidity this year. And I expect that to flow back into the private markets, which means you have funds that are being funded, which means you have startups that are being funded again. The other uh, the other ag tech specific capital component was the fact that pre 2021, and this is more anecdotal, but pre 2021, we saw a lot of climate investors in the space. Uh, you saw you saw a lot of interest in how big of a market food and ag is, in uh, a lot of regenerative carbon sequestration, general biodiversity, interest in food and agriculture. We have anecdotally seen post 2021 a drawback of some of the more climate focused dollars into food and ag, which just means a smaller pool for ag tech founders to raise off of. I will say again, anecdotally, we are in the last year starting to see entrance again from climate investors, from deep tech investors, in some ways from defense investors, but again, generalist investors looking for the next opportunity. Um, Everyone on this call obviously sees the opportunity in ag tech and in food and ag broadly, or we wouldn't be here. And I do think in the last year we're starting to see the market open up to that. Maybe the best example is if anyone's followed Halter, raised at a $2 billion valuation. I don't think that's something that would have happened in ag 2 years ago. And so I think we're coming back. It's a combination of liquidity in the market. It's a combination of generalist investors starting to be interested in food and agriculture again. Um, and then to my point earlier about diversification away from AI, um, I think that's also what's driving some of the generalists back into food and agriculture, is that you have a physical industry that we believe broadly cannot be replaced by AI. Like, yes, AI will enable OEMs, agrochems, the ABCDs of the world, you name it, uh, and and hopefully enable farmers if we can see some increased adoption. But the industry isn't going anywhere. This isn't pure software. We don't have to worry about SaaS apocalypse. We've got a differentiated industry that's not going anywhere.
Sweet. That was a really good and helpful answer. Next question. What minimum level of ROI does Lewis and Clark consider makes it a successful investment, and by extension consider that it has invested in a successful company?
Yep. So this is going to vary by stage that you invest. We are not early stage pre-seed and seed investors, so I will comment on pre-seed and seed ROI, um, and then I'll comment on growth, like later stage ROI too. But with those two, take what I say not as gospel. But what I understand is at the earlier stage, or across the venture life cycle, everything again comes down to risk to return. And so at the earlier stages, you're investing largely 0 to 1. Can they take this from an idea to a product? That is very risky and requires underwriting individual companies close to a 10x return. Um, and that works because you invest across you build a portfolio of a number of companies where you expect that some of them will not be successful, some of them will do okay, and a handful will outperform. And maybe you'll hit that target or exceed that target. At the later stage, or mid stage A to B to C, we typically target a 5x return on investment. Again, and that's with 5x plus, and that's again with recognition that some of those companies will outperform, some of those companies will not perform, but those outperformers and the way we underwrite any investment all kind of come back to that exit question I brought up. Like for us, is it a 5x if you exit to that core list of acquirers? If you're working on autonomous tractors or a See and Spray retrofit technology, is there a 5x if we can exit to Deere? Because that's the most logical acquisition. But is there upside in general industrials or the broader OEM market? And then the later stage investors are typically underwriting a 3x, again, because they're taking on lower risk. You're at many tens of millions in revenue. There's a clear path to profitability. What they can underwrite is if the home run doesn't land, I can at least build an enduring business to sell on a financial exit, and that's on an EBITDA multiple. So it does vary. I can speak for Lewis and Clark, typically looking for 5x plus investments, and that's off of our pro forma, not your pro forma, which is typically different. And then hopefully that answers the whole spectrum as well.
Very good. What other questions do we have? Okay, cool. I think this is great. Bryce, what other resources would you recommend to our attendees here, and where can they learn more about you? We do have another question here. Um, Next question is, do you look for a minimum return, not just 5x? Is there something lower?
Yeah, so it's kind of the portfolio approach. We like to underwrite investments to a uh, minimum amount size, like in dollar value. No, what we care about is cash on cash. So or multiple on invested capital. So if it's a $1 million check or a $5 million check or a $10 million check, if we underwrite every investment at minimum to a 5x, uh, it doesn't matter what the dollar amount was. What matters is our return on capital. And I think that's important too as a founder, because that gets back to how much capital am I going to raise? Because the more capital you raise, if every dollar invested needs a pending stage needs a blended 5x plus, uh, that's the exit that in an ideal world you would sell for. And the higher that gets, I think the harder it is to achieve, which is why capital efficiency is very important.
Okay, very good. And with that, as I was kind of alluding to before, what resources do you recommend and how could anybody from the call contact you?
Yep. So I think that the combine's an incredible resource. There is unfortunately a gap. I think there's a gap in resources across ag tech in that early stage. And I think the combine fills that and does an incredible job filling that in helping companies from 0 to 1. The one to many, there's still probably not enough capital in the space and not enough resources in the space, but that 0 to 1 is the biggest challenge. And so I would recommend getting to know the Combine, Grand Farm in North Dakota, the Reservoir in California, Ag Launch, you name it. And that's really, I think, the best way to get off the ground. From the one to many, I I don't want to be self-serving here, but I do think the best resource is a value add investor. If that is your goal, if your intention is to take venture capital, the right investor can be the best resource for you. Um, Specifically in connecting you with the right people, again, because your incentives are aligned. Uh, Other than that, if we're talking just ag tech now, it's farmers. It's talk to as many farmers as you can. Depending on the market you serve, farmers, ranchers, um, specialty crop growers, retailers, you name it. If Which brings me back to point one. I mean, if you understand your customer, you'll build an enduring business. And then, how can you reach me? Please reach out with anything. I'm happy. I hope I've been clear about our stage, but I am more than happy to get to know, help in any way I can. Uh, if you're building at the earlier stage, we're kind of all in this together. Like I said, what's good for you is good for the ag tech industry, which is good for me, and we're all in this. So you can find me on LinkedIn. Our website is lacpartners.com. My email I'll put in the chat right now. Um, Open to it all.
Very good. And we've been here for about an hour. I feel like that went so fast, but for all of our attendees and Bryce as well, we're going to continue these webinars. So just stay tuned for more. And thanks so much again for attending. And I will also post this on our YouTube if there's something you want to go and take a look at again. So thanks so much, everyone, and have a great day.
Thanks all. Thanks for having me, Jesse.